This morning, something landed on my desk that made me pause. Data indicating that $5.7 billion quietly exited American financial markets. Nobody announced this shift, held a press conference, or declared a boycott. It was a silent, strategic move executed with the precision of a surgeon, and that lack of noise is precisely what makes it so alarming. While observers waited for a defining political confrontation, serious money had already begun to flow in a single direction. Away from the United States, this massive redirection of capital did not occur by accident. It traces back to a specific decision made in Washington. In February 2025, the Trump administration announced sweeping 25% tariffs on Canadian goods, a move Ottawa immediately characterized as a betrayal of long-standing partnership. The typical response to such an action is fiery political rhetoric and consumer-led boycotts, which can easily dominate news cycles. But the silence that followed from Canadian officials did not indicate inaction. Instead, it masked a deeper strategy that was already unfolding beneath the surface of the trade dispute. That sequence is not coincidental. It is a direct policy statement. Mark Carney, newly sworn in as Prime Minister, chose not to escalate using emotional language or headline-grabbing campaigns. His administration did announce dollar-for-dollar retaliatory measures, placing 25% tariffs on $30 billion in American goods, with a second phase targeting other sectors kept on standby. However, this was merely the public, visible layer of a response designed by a leader who understands sovereign capital flows intimately from his time leading the Bank of Canada and the Bank of England. The real impact was happening in financial markets. The $5.7 billion figure is not a projection. It represents actual tracked outflows documented by established financial intelligence firms and later confirmed by Bloomberg, which noted unusual reductions in Canadian holdings of American Treasury bond positions. This detail tells you that the correlation between the tariff escalations and the timing of the outflows is precise and deliberate. Institutional investors, controlling hundreds of billions of dollars, do not move asset based on political headlines. They react to forward-looking risk models. When those models began flagging elevated American political risk, reducing exposure became a fiduciary obligation, not a political statement. This distinction is critical because it determines how permanent the capital shift becomes. Political disputes can be resolved with a single handshake, but a fiduciary reallocation requires formal policy reviews, committee approvals, and model rebuilds. Those processes do not reverse simply because a tariff is temporarily suspended. This deeper mechanic is what most observers, distracted by political drama, completely miss. Canada is not an actor American market strategists should dismiss lightly. The Canada Pension Plan Investment Board alone manages nearly $570 billion, making it one of the most powerful institutional investors globally. The two nations exchange over $760 billion annually, with Canada standing as America's single largest trading partner. In early 2025, analysts began tracking unusual patterns as Canadian institutional money surgically trimmed exposure to pillars of core stability: technology holdings, financial services, and long-duration treasury bonds. That strategy is now widening, creating ripple effects that travel far. Canada's 8 largest pension funds collectively manage over $2 trillion. A 2% shift away from American markets represents $40 billion moving. Sources at these institutions confirm that diversification discussions are accelerating internally right now. Fund managers are actively looking toward European sovereign bonds, Asian equities, and domestic holdings. The current $5.7 billion outflow is almost certainly just the first traceable signal of a considerably larger rebalancing. This trajectory is already visible in actionable capital decisions. When Germany unveiled a €500 billion infrastructure fund in early 2025, Canadian pension funds were among the first international buyers. Just 1 year prior, that same capital would likely have been allocated to American markets. This trend indicates that once embedded in governance documents, new allocation mandates require a formal board vote to reverse, which often follows a lengthy quarterly cycle. The broader international context exacerbates this trend. European finance ministers are encouraging Canadian engagement, and Japan's government pension fund, the world's largest, holding over $1 trillion in American treasuries, is noting the pattern. A March 2025 warning from Deutsche Bank analysts identified a scenario they termed allied capital flight, describing traditionally friendly nations simultaneously reducing American exposure. Senior economists are now drawing parallels to the mid-1970s dollar crisis under Nixon, when allied nations first questioned American financial reliability and diversified their reserves. The number appearing in closed-door briefings right now for the next phase of this reallocation is $17 billion. Key players like the Ontario Teachers' Pension Plan, managing $250 billion, and OMERS have already adjusted their equity positioning, citing geopolitical risk and political unpredictability. What began as a reaction to a tariff decision is hardening into a structural, long-term capital reality. The question is no longer whether more capital will follow, but exactly how much pressure that continued outflow will exert on American borrowing costs. The silence observed in Ottawa was not a sign of diplomatic paralysis, but the preamble to a highly calculated financial maneuver. In the wake of Washington's surprise 25% tariff announcement in February 2025, the initial $5.7 billion capital flight from American technology, financial services, and treasury markets marked only the earliest phase of a broader realignment. That initial movement shifted the focus from public trade disputes to the quieter, more permanent mechanics of institutional capital. As fund managers adjusted their models to account for heightened political risk, the strategic intent behind Canada's economic repositioning began to surface. The coordination governing these capital movements became clear through specific, synchronized adjustments across Canada's largest pension systems. According to public regulatory disclosures released in May 2025, the Ontario Teachers' Pension Plan and OMERS simultaneously reduced their combined American equity exposure by an estimated $4.2 billion during the first quarter. That sequence is not coincidental. It is a direct policy statement. By altering their asset allocations at the same time, these distinct funds demonstrated that they were reacting to a uniform risk signal. What that behavior indicates is that institutional investors had collectively categorized American policy unpredictability as a structural threat to long-term portfolio stability. The mechanics of this shift are driven entirely by risk management protocols, rather than political sentiment. Internal governance documents from the Public Sector Pension Investment Board, which handles over $230 billion in assets, revealed that its risk rating for American sovereign debt was upgraded to an elevated tier following the tariff announcement. That detail tells you that the reallocation is a binding fiduciary requirement rather than a temporary protest. When an internal threat classification rises, fund managers are legally obligated to diversify away from the affected jurisdiction to protect beneficiary capital. This structural reality means that the capital flows are governed by mathematical optimization models that cannot be overridden by political gestures. The direct financial consequence of this reallocation is starting to register in the demand structure for American debt. Treasury Department capital flow data from April 2025 indicated a 12% drop in net private Canadian purchases of long-duration bonds compared to the previous rolling quarter. Here's what that means for the broader financial system. As the largest trading partner systematically steps back, the depth of the American bond market faces an incremental, compounding squeeze. That contraction places upward pressure on yields, which directly influences the benchmark rates used to price corporate debt and consumer loans inside the United States. Canadian officials have framed this transition not as an act of economic warfare, but as a necessary adaptation to a changing regulatory environment. During a closed-door briefing with financial executives in Toronto, Finance Minister François-Philippe Champagne stated that reliability is the baseline currency of institutional trust. And when that baseline shifts, capital must find stable ground. What that response reveals is a deliberate choice to frame the capital movement as a neutral, defensive measure. By attributing the reallocation to a loss of policy predictability, the Canadian government effectively shifts the responsibility for the capital flight back onto the administration in Washington. The institutional pivot is further validated by the rapid deployment of these redirected funds into alternative Western economies. Sovereign debt registries in Europe confirmed that Canadian pension funds absorbed approximately 15% of Germany's initial tranche of its €500 billion infrastructure bonds. That sequence shows a direct substitution of American assets for European ones that offer higher regulatory predictability. This structural realignment means that billions of dollars that previously financed American public and private debt are now actively funding the long-term industrial modernization of its global competitors. This systematic detachment has now reached a critical juncture where the long-term stability of cross-border financial integration depends on an upcoming legislative milestone. The definitive test for this capital trajectory will occur during the formal review of the Canada-United States-Mexico Agreement, scheduled for later this month, where Washington plans to introduce sweeping structural changes to continental trade rules. The outcome of that specific meeting will determine whether the current $17 billion second phase capital reallocation mandate is formally triggered or suspended. The intersection of trade policy, institutional mandate adjustments, and synchronized capital flight has created a highly intricate chessboard where conventional political leverage no longer functions as intended. The escalating tension surrounding the impending review of the continental trade framework highlights that the modern economic arena is governed far more by institutional risk models than by public declarations. As the second phase reallocation projection of $17 billion hovers over the financial markets, the strategic landscape is adjusting to a reality where the long-term positioning of sovereign capital has been fundamentally redefined. This shift changes the operational calculus for every major global actor, transforming a bilateral border dispute into a structural realignment of international finance. For Canada, this silent repositioning represents a calculated transition towards strategic autonomy, moving beyond its historical reliance on a single economic partner. By embedding diversification mandates directly into the governance structures of pension funds managing over $2 trillion, Ottawa has effectively insulated its core financial reserves from sudden policy shifts in Washington. This strategy allows Canadian policymakers to absorb the immediate impact of trade restrictions while simultaneously executing a long-term capital migration that minimizes downstream vulnerability. The message embedded in this approach is clear. Trade terms may remain subject to political negotiation, but the underlying capital architecture will be steered exclusively by policy predictability and fiduciary safety. Conversely, the implications for the United States extend well beyond the immediate boundaries of the trade balance sheets. The systematic withdrawal of Canadian institutional money from technology holdings, financial services, and long-duration treasury bonds removes a critical layer of stable, non-speculative capital from the domestic market. As the depth of demand for American sovereign debt contracts, the broader financial system faces a compounding pressure that inevitably surfaces in benchmark interest rates. This transition signals a broader vulnerability where the unilateral use of economic leverage inadvertently diminishes the structural appeal of domestic capital markets to traditionally reliable allied partners for alternative destinations like Europe. This capital migration provides a direct and substantial injection of long-term investment into their strategic projects. The rapid absorption of German infrastructure bonds by Canadian funds demonstrates how quickly institutional capital reroutes when a primary jurisdiction introduces unpriceable political risk. This trend accelerates the financial depth of regional markets that maintain high regulatory consistency, effectively allowing global competitors to finance their own industrial modernization using capital that previously sustained American markets. What that framework does structurally is tilt the balance of global investment gravity toward regions that prioritize institutional predictability over tactical trade maneuvers. Ultimately, the overarching pattern reveals that the traditional rules of economic deterrence have undergone a profound transformation. When a major trading partner systematically alters its capital trajectory without a single public announcement, It demonstrates that the most consequential economic shifts occur entirely outside the view of public media. The silent unwinding of long-standing cross-border capital dependency proves that policy unpredictability carries an automatic compounding financial penalty that cannot be managed through political messaging alone. In the modern global economy, capital does not engage in political theater. It simply migrates to where the rules remain stable. This strategic shift underscores the reality that the true cost of a trade confrontation is never measured solely by the height of its tariffs, but by the permanent displacement of the capital that underwrites the entire system. When trust is removed from the financial equation, institutional models automatically execute a structural rebalancing that long-term diplomatic gestures can rarely reverse. The quiet exit of billions from American markets marks the beginning of a landscape where financial integration is no longer assumed, but continuously audited against political stability. In this new economic environment, the most powerful strategic statements are those made through the silent, mathematical reallocation of global wealth.